Hello. So far, we talked about consolidation at the point of the ownership transaction, um, about 100% ownership and 80% partial ownership, right? Because we explained in capital market, you don't need 100%. You don't need sometimes you don't even need the majority of the stock to control a company. So economically, it's not a wise decision as well to commit too much. Sort of goes against the rule of diversification. So most of our cases, realistically, we're going to see partial ownership controlling parent company, controlling subsidiaries with partial ownership. But the controlling will be going on. We said it's held to maturity stock. We said they're going to commit their controlship for not for profits, not for share price buy low and sell high, but for strategic reasons, which is going to last a lot of years, right? So it's important to talk about, hey, after operation, after a certain amount of years of operation, what's going to happen? So we're going to touch this in our class. Today, our goal is to cover a few fundamental things. Fundamental things. There won't be homework uh, for today's topic, but we're going to cover a few fundamental things, and then the next video we will explain a lot more complicated stuff like, hey, when the years goes by, what's going to happen? What's going to happen, right? Or how it's going to the ownership, what's going to happen to the consolidation. Okay, so if you look at the screen, so here's a balance sheet of big and small. Here's for small, here's book value and a market value. Why for small we have the book value and a market value? Let's talk about the perspectives in this two-man case, two company case, right? We have company big and we have company small. Big is going to control small through owning, getting control power over small's ownership, right? So when big buys, so when big controls small, right? Big needs to buy. Big need buy companies' shares based on company small's value, right? When big appraises company small's value, of course, it determines small on the whole package. We said the whole package includes not only whatever shows up on balance sheet, but also includes good employees, good combination, good synergy, political connection, somewhat advantage, named or not, right? So all of these, they are based on the market value. When you buy things, you base it on market value, right? Market value of small's whole package will of course be different from the book value because book value is historical cost, right? So for big has its own balance sheet, no problem at all. It's big's own perspective already. But when big buys small, basically when big controls small things at that point of transaction becomes big things, right? Big's belongings, big's assets and liabilities, right? So big needs to use market value to assess everything. Like what we see here, cash, AR, inventory, PPE, land, investment, all the different things. They have differences. Some of them have differences between market value and book value. And because big is a buyer, big is assessing, big is controlling, so everything should be adjusted for smallest part to big's perspective. So same logic, when we do consolidated financial statements, those things should be based on big's perspective as well. Right? Small has its own perspective. We talked about it when the ownership structure changed. Nothing happened to small. Small is a legal, from the perspective of the business law, small is independent from the owners. Small didn't gain a thing, small didn't lose a thing, so small doesn't change. Small will still stick with its historical accounting, historical cost. But when big consolidates, right, everything that is from small's own perspective will be translated into big's perspective. That is the consolidation we are talking about. That's the key of consolidation. So we have to understand from different perspectives what's going to be different. So here we see a few, right? For cash, AR, inventory, there's no perspective difference in value. For PPE, market value is lower than book value by 2 million, which means in the eyes of big, although the machine in small book shows 5 million, or small things is 5 million, the market value is 3 million. And from whatever big paid, they only pay 3 million for the machine, right? For the land, book value 2 million, market value 4 million. Right? And another thing that is interesting is customer list. Pattern is the same logic, right? It's customer list. Why it's interesting? Customer list is self-developed, right? So from historical point of view, from historical cost point of view, we know that when a company operates, gradually, if it's going well, they will accumulate customers. They will have a customer list. Other pay money for that, but for a company, it's just a byproduct of operation, right? So when we talk about a small itself, customer list, not that it's not valuable, but from the accounting perspective, there's no accounting value to it, but it's worth something, right? So on small book, customer list is nothing, but when big buys small, big have access to small customers. So it's worth something too big. Here it's worth 2 million, right? So we have these items and the pattern we explained already. We have these. But if we talk about the operation, we have to think about one thing, right? That is, what is that is at the point of transaction. We know, take PPE for example, right? PPE from big's perspective is 3 million. Small's PPE from big's perspective is 3 million. From small's own perspective is 5 million. And a PPE has a useful life of 5 years, as my mark. Those are years, right? 5 years, 10 years, 10 years. So here PPE has a useful life of 5 years. What does it mean? If I don't say anything specific, we use straight line and assume 0 residual value. So what we talk about here is that for small, the PPE at the beginning of 2014 is 5 million, with 5 years of useful life left, which means in the next 5 years, every year, the depreciation will be 1 million. While small, big only assign 3 million to PPE, also 5 years of useful life. So in big's eyes, small's PPE only generates depreciation in the amount of 600,000 per year, right? And keep in mind, right, when there's depreciation expense, it will reduce net income, right? So if we take a look just at a PPE, when small reported its net income, right, to arrive at its net income, small will subtract from revenue by 1 million every year due to depreciation. However, from big's perspective, they will say that, hey, your PP is not so much, so your depreciation is not so much. You subtracted too much. Your net income is actually higher by how much? Small subtracts 1 million, big things, it should be 600,000. So the net income should be higher from big's perspective by 400,000. Right? And let's take a look at land. Land don't generate. Land has infinite useful life. So there's no depreciation. Remember that? So land, there's no impact, right? Let's take a look at the customer list, all right? Customer list, of course, customer list is not forever, right? Here we assume it's 10 years useful life. So big, from small's own account, small views the value of, assigns a value of 0 accounting-wise to customer list, okay? So every year it amortizes 0. However, from big's perspective, customer list is 2 million, has a useful life of 10 years. So every year, 200,000. So if we just look at the customer list, we know that when subtracting amortization due to customer list from total revenue to arrive at net income, small, when they calculate, it's only net income. Small subtract 0, but big will say that, hey, look, you are not calculating from my perspective, right? When I'm calculating your income, I should subtract another 200,000. 2 million, 10 years, 200,000 a year. So if we just look at the customer list, your net income from my perspective should be 200,000 lower than what you have reported. We can apply the same logic to pattern, okay? You see where it's going? So when there's some assets on small side, right, the party being consolidated, when there's a difference between the book value and the market value, if those assets happen to be long-term assets with finite useful life, we have to take into consideration the subsequent impacts from depreciation or amortization, because they will impact, right? They will impact the calculation. So let's figure out, right? Let's figure out. So let's talk about PPE. Right? PPE, we asset name. I'm going to upload this whole copy with other questions to, I'm going to save here as well, with the whole copy to Blackboard. Asset name, book value, market value, useful life, let's call it UL, right? Difference. Oh. So let's see what we get, right? So remember, only for those with differences between book value and market value. So how many, and only for smalls, right? So how many candidates do we have? Cash, no. AR, no. Inventory, no. PP, yes. PP book value 5 million. Market value 3 million. That's one thing we have. After PP, we have lands, right? We have lands, and we have customer list. We have patent. PP. So for lands, book value is 2 million, and the market value is 4 million, right? For customer list, book value is 0 with that, and it's 2 million, right? For patent, book value is 2 million. Market value is 5 million. All right, so let's talk about useful life, right? So see where we come from. Useful life, PPE, 5 years. Lands, infinity. All right, what's the infinity sign? Oh. And the customer list, 10 years. And the patent, 10 years. Right? So what do we learn here? What do we learn here? All right, let's do it step by step. We can do it in several ways, right? One is, they are all about smalls, right? They are all about smalls. And here we talk about a perspective. Perspective, right? From here's perspective of small's own, of their own opinion. Here's big's. Right? So from small side, which is big, which is the PPE, right? Which is the PP value, book value. The depreciation is 1 million each year. And from big's perspective for the PPE, the depreciation should be 600,000. So we can apply the same thing here. And here we don't have any, because any number divided by infinity is going to give you 0, right? So it's actually 0 here and 0 here. Right? So what do we learn here? What we know is let's calculate the difference. What we know is, from big's perspective, there should be only 600,000 depreciation based on 3 million PV value. And from small's perspective, depreciation should be 1 million, right? So since we are talking about adjusting from small's perspective to big for consolidation, which is from big's perspective, we use big to subtract small from big to compare the differences, right? So what we have here is, right, so big thinks from PPE, depreciation should be not thinks, right? From big's perspective, big's value assignments, the PPE depreciation every year should be 600,000, and from small side is 1 million. So when small calculates its net income, right, we can see here, depreciation expense is 1 million, while actually it should be 400,000 less, right? So here it should be 400,000 less, adjusting, what I'm talking about adjusting, okay? So we are all talking about a small here. We should adjust this. And for amortization, we know that the total amortization is 200,000, right? Only from patent. But compared to small, who assigned 2 million book value to patent, big thinks the patent, big's eyes, patent's worth, the market value of patent is 500,000. So small amortizes 200,000 a year, big said it should be 500,000 a year, right? So 300,000 more expenses debit item, right? And small doesn't amortize customer list because there's nothing from their end, and the big amortizes 200,000 because big assigns 2 million value with 10 years useful life. So another 200,000. So adding up to 500,000. Right. So basically here we know that the total should be so for revenue, there's no perspective difference, right? They are all making money that year, so there's no difference. For cost of goods sold, no difference, right? And for depreciation, we know that it should be 600,000, should be adjusted down by 400,000, right? Because too big, the PP is worth much less. Market value is lower than the book value. And for land and for customer list and patent, which both of them generates amortization, right? Small is not amortizing enough. Should be 500,000 more. 200,000 from customer list, 300,000 from patent, right? So 500,000 more. So the income statement items from big's perspective, it's gonna be revenue same, fuel just same, depreciation 600,000, amortization 700,000. So the adjusted net income should be this much. Should be this much, right? 1,700,000. That's the adjusted income. And why it's important to know this? Let me ask you a question, right? Big owns 80% of small. What does it mean? Meaning that when small has income, big takes 80%, right? So, but a big investment income belongs to whom? Investment income belongs to big. So it should be calculated based on big. So when big calculates investment income, it is 80% of whatever from big's perspective, small has made, right? So from big's perspective, small made 1,700,000. And if you can calculate, right, $1,700,000, 80% of this is gonna be 1,360,000, which is investment income, right? So we kind of link this investment income and a small's performance thing together, right? Do we see that? And also with that knowledge, we can move on to the next topic, right? which is investment account, which we're gonna cover in the next class. All right. So this is for today. Let's think about these examples. Let's think about why we have to calculate the difference for balance sheet for the depreciation, amortization related items. Let's also think about what is adjustment for. Let's be aware of the perspective differences. Again, big is the one reporting, so everything from big's perspective, and small when the ownership changed, right? Small were still doing its own balance financial reporting with its own historical cost, right? The older one never changed. When big becomes owner in the house, big will fix everything. When big is the owner of the group, right? So when big does reporting for group, which is a consolidated financial reporting, big need to adjust perspectives, right? That's exactly what we have here. All right. So that's all for today. Thank you very much. Bye-bye.